Hello everyone, today's vlog is all about setting up a business overseas. First thing to consider is the size and the permanence of the nature of your overseas operation. Will you have a salesperson on the ground? Will you have an office? Will you have more of a permanent presence? All these things will dictate how it is taxed. It could be merely an extension of the UK business where it forms a separate division and it'll only be subject to UK tax. If it's more permanent, the overseas territory will want to have some tax take over there on the profits. So then you're in the realms of double taxation. Thankfully, there are double tax treaties between the UK and literally dozens, if not hundreds, of overseas territories, which means that you don't suffer tax twice on the same profits. So you need to consider that. You need to consider if you are in what's deemed to be a low tax jurisdiction, because the next step would be to set up a limited company, a subsidiary of the UK company, which would be taxed under normal circumstances just in the overseas territory. However, if it is a low tax jurisdiction, then the UK has anti-avoidance rules which take a share of the profits and tax them to the UK. So you could have, again, double tax problems, even though you've got a separate legal entity in the overseas jurisdiction. What about personnel? Do you need to transfer people across from the UK, or can you use local personnel? What are the tax consequences if you do choose to move personnel across? What about continuing on with the national insurance contributions? What about the local employment taxes? What about the income taxes for the staff? Things like what they call equalisation provisions to make sure that the employees don't suffer any more tax than they would have done had they stayed in the UK if you're moving them to a higher tax jurisdiction area. So you need to think about the local employment laws as well as the tax. You need to think about capital controls. Can you get your profits of your overseas business repatriated to the UK? Is there a limit on the amount of money that can be taken out of the overseas country, or would you have to leave some of it or a lot of it invested in that territory for future expansion? What are the tax consequences of repatriating profits? You need to make sure that the entity that you've set up overseas is comparable to a business in the UK for double tax relief to work. So to give you an example, in America, they have several different types of entities for business. In the UK, we have what's known as an opaque business, which is a company, or the other expression is a transparent business, which is a partnership. In America, it's not so cut and dry. You can have entities which change from opaque to transparent just at the tick of a box, which causes problems for double tax relief. Because if the UK tax authorities think that the American entity is opaque, for example, but the US authorities think that it's transparent, then you could have all sorts of problems with double tax, so that where no double tax relief will occur. So really need to give serious thought to the structure of the overseas entity if you've taken the step of going beyond merely a branch or a on the ground salesperson and set up a company, specifically what type of company. Very important. So the intellectual property, what do you do with the IP? Is there going to be IP held offshore? Is it going to be kept in the UK? If it's held offshore, will you be charging a royalty fee back to the UK? Will those royalty fee payments from the UK to the offshore place of business be tax deductible in the UK? What's known as transfer pricing rules, all sorts of tax provisions around excessive royalty payments out of the UK, which obviously costs the UK Treasury money because it erodes UK profits and therefore erodes the UK tax take. Or is it better to leave intellectual property onshore and make use of other UK tax breaks, such as the patent box rules? You'll see my separate vlog on the patent box to take advantage of lower tax rates as an encouragement to leave intellectual property onshore. What about debt financing? How are you going to fund the overseas business? Will you load it with debt? Again, where will the debt come in? Will the debt come into the UK and then the UK lends overseas, or will you take a loan out overseas and have the funds come into the overseas entity? Because again, deductibility, similar with royalty payments on interest. The UK has some specific rules, some anti-avoidance provisions on businesses being loaded up with too much debt, which therefore gives rise to excessive interest payments, which are tax deductible. So the UK government have put the brakes on the tax deductibility of that interest to discourage people from loading up too much debt into various entities, which triggers what the UK government believe to be an excessive interest deduction in the account. So debt and funding have to think about how to structure it. Will you get tax relief on the interest payments? What about the reporting requirements? Do the overseas entities have similar system like we have in terms of Companies House, annual accounts? Is it more onerous or less onerous? A lot of red tape for companies in the UK. Is it going to be worse or better overseas? What about the actual rate of tax, the tax authorities? Do you need to file accounts and tax filings quarterly or annually? What are the deadlines? They may be completely different to the UK system. Indeed, you may have no choice. For example, if you set up in various places, you have to have a calendar year end for your business, whereas in the UK, you can choose any year end for your company that you want, which can make things a bit tricky when you're trying to align everything up, but it's just something that you need to think about. What about VAT, sales taxes? Is there an equivalent of VAT in the overseas territory? Yes, if you're setting up in the EU, then you need to consider registering in each state that you are doing business in. Indeed, a lot of people trading even online, for example, trading on Amazon, would need to register for VAT in every EU country that they trade in. Now, for many of these countries, there's no threshold. In the UK, you don't have to register until you have a turnover of 85,000 for VAT. In the EU countries, it's often zero. So the very first sale you make to EU countries, you have to register for the VAT in those countries. So having multiple VAT registrations is obviously very bureaucratic. But outside of the EU, similar concepts around the world. Goods sales taxes. What about state taxes in America? You might be selling to multiple states in the USA. Each state has sales taxes in addition to federal taxes at the government level. So consider all the local taxes, import duties, tariffs, hitting the headlines at the minute, all the trade wars between the US and China, but it's not just those two nations. Every nation on the planet has some sort of tariffs or free trade agreement or import-export provisions, so you need to consider those. Will items be held at the docks in the ports for a longer time than you used to with your current trading partners? Can you get access to the goods? It ties into similar to the capital controls on the money side of it. So lots of things to consider when you are setting up as a business abroad. Even if you're an SME, if you're a small business, the mere fact of just trading online, you are dealing with overseas customers, still matters that you need to think about, such as the multiple VAT registrations across the EU. So if you like this video, please do subscribe, and I will see you soon.